What is going on, guys? What is going on? All right, so we got the Fed decision at 2 p.m. More importantly, we got the Fed speak. Oh, this looks like a long here. This looks like a long. More importantly, we got the Fed speak at 2:30. Do we expect rate cuts? No. We expect the Fed to keep things as is, but that is not the important thing. The important thing is what the hell the Fed says. This looks like a long here, guys.
UT.com.
Welcome back to The Exchange. I'm Seema Modi with your CNBC News update. President Trump has appealed his New York hush money conviction in a notice of
one thing is a report from the White House just came out saying that they're putting new restrictions on, or considering putting new restrictions on chips. So we're seeing chip stocks down. Now, as I said, there is going to be absolute fireworks in chip stocks, and fireworks, I mean, in both ways, right? Could be fireworks up or fireworks down, but absolute fireworks after tonight. So tonight we have Nvidia and Meta reporting earnings. Now you might say to yourself, why do we have, or why would Nvidia or Meta affect chip stocks? Why would Meta or Microsoft affect chip stocks? And the reason is because what is this? RFK Jr.'s heated Senate hearing. The reason is because we're going to see whether these companies are reducing their AI capex spend or increasing their AI capex spend. And if they are reducing their AI capex spend, then that typically means, or what that would mean is that for the moment, AI hardware stocks, so chips and infrastructure, are going to take a beating, right? Because what essentially that would mean is software is becoming more efficient. What that would also mean is in the very short term, these companies are spending a ton on AI, and now they're going to try to make some of that money back by leveraging that to produce new goods and services that are AI based. And you know, they want to take the time to create that so that they can then build upon that in the future. So more than FOMC for me, which I don't think the Fed is going to raise or cut rates, are going to keep things the same. But more importantly is going to be Meta and Microsoft earnings tonight. Tesla to a lesser extent because it has a different approach as it relates to AI. Today is Nvidia reporting. Bro, you can easily Google this stuff, okay? And no, Nvidia is not reporting today. So what I'm expecting I'm not going to be playing Meta I might play Meta earnings. I'm not playing Microsoft earnings, definitely not IBM, but I am for sure going to be trading Tesla earnings. So already went live this morning talking about my potential play on Tesla earnings. The reason I'm not going to play Microsoft earnings is because they don't beat or meet the expected move most of the time. It's somewhere 50-50 in the middle. So there's nothing for me to trade there. So I'm more interested in Microsoft and Meta earnings than I am interested in the Fed meeting today. Also, please remember the first move that you see today doesn't mean that that's the move that's going to last for the week or next week or whatever, right? It's always the case that someone's like, why is the market going up? Why is the market going down? Right? This is the nature of binary events, okay? It's just meant to engineer liquidity. That's it. Now, I want to see what the move is leading up to Powell speaking, right? So at 2 p.m., you have the decision, which is going to be a pause again, in my opinion. And then we're going to have Powell talking. Now, we all know that the battle between Powell and Trump is heating up. What this means is that Trump is trying to get Powell to lower rates to zero. And Powell is saying no, or will say no. So Powell is not going to cave to Trump, at least not in this first meeting. But it's going to be very important what he says, because he can sort of find a happy medium where he keeps rates unchanged, but then offers up a little bit more dovish speak. Or he can keep rates unchanged, offer a little bit more hawkish speak, right? So what he says is going to be overanalyzed today more than almost any other FOMC meeting that we've had since they started raising rates. What is your Tesla earning trading plan? I'm likely going to be buying a Strangle. Why do you answer stupid questions? That's actually a good question. I don't know. What time is FOMC? That is a stupid question. Yes, because I just mentioned it 100 times. Surf, appreciate your donation to St. Jude. Thank you so much. Court, Soner, Elon, Francisco, Simon, Jonathan, Kevin, Polly, Rhett. What is going on, guys? Kenan, what is going on? Sunil, what's going on? Buy Nvidia. Please give your thoughts. No. No thoughts. My thoughts are exactly what I just said. Nvidia is going to, in the short term, if you're only worried about the short term, you don't buy Nvidia here. Nvidia is going to rely very heavily on what Microsoft and Meta announced today. Nvidia is also sitting at the 100-day moving average. Sorry. Nvidia is sitting at the 200-day moving average, right? Something that it hasn't visited in 2 years. And in bull markets, when it does visit the 200-day moving average, it can spend weeks here, right? So everyone wants it to move fast because they have no idea why they're buying Nvidia. They're just buying it and praying. Nvidia can spend weeks here. And if you're buying, the only reason you should buy it here is for the long term. This is not a short-term play. As I said in my video yesterday, I don't think there is a short-term play on Nvidia. I think right now you are just adding for the long term. If you don't want to trade the long term, do not add Nvidia. Simple as that. Buy Tesla. Do whatever you want, bro. SPY reaction. What do you think? Any thoughts? No thoughts, guys. No, I have no thoughts. I don't think. Thoughts on prayers? That's a good question. I think prayers are important in certain situations, not in market situations. Would you buy Nvidia at this price point? Okay. You're right. Whoever said, why do you answer stupid questions? I literally just answered this 5 times in a row. If you cannot understand what I'm saying after 5 times in a row, please give me some peace. PBL. What the fuck is PBL? Can you turn up the microphone volume? Is everyone else having this problem? Christine Nguyen? Wait, which Christine Nguyen is this? I'm asking because it's if I'm thinking who it is, it would be one of my good friend's long lost family member. I'm not sure if this is the same Christine one. I come here for the jokes. I'm sure most people do. Dun, 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 dun. All right. We have 18 minutes until the Fed meeting. Or sorry, until the Fed decision. And then 2:30 is the Fed meeting, 2:30 p.m. Eastern. Dun, dun. Vicente Guerrero's here. What's going on, bro? Mm-mm. All right. So what I'm looking for is I want to see what the move is after the Fed speaks, or sorry, after the Fed decision is released. And then I want to trade the counter trade to that move. So right now, this looks like a potential long here, in my opinion, coming off of this 4-hour fair value gap, right? You see that there is a bullish divergence between ES and NQ, right? So ES made this higher high. Look at NQ here, higher low. NQ here made a lower low, right? And then after sweeping that liquidity, we formulated this 4-hour fair value gap, and we are now trading into there. So I want to see if there is a long here at 2 p.m. And then I want to trade the counter to that leading up to the Fed speech. But in terms of Tesla, no, I'm not buying Tesla here. Tesla's reporting earnings tonight, and I don't see the point of buying Tesla right before earnings. The expected move on Tesla is plus or minus $35 from here, right? $35 from here. So I think that it can achieve that, which is why I want to buy a Strangle. Nvidia, to me, is only a buy for the long term here. I don't see any short-term options. There are a couple of stocks which I think are going to blow up in the short term. We already have a position on Costco, which I think is a monster setup. And I may go back in after a huge day yesterday. I may go back in Datadog today. Not sure. But it is definitely, it broke out and it retested the 50-day moving average. As you can see, we broke out and are retesting that 50-day moving average at this major trend line here. And we also filled this gap that was formulated by yesterday's breakout. So you can see that gap there, that volume imbalance. We filled that. So Datadog earnings aren't until February 13th. Between now and then, I think we can see another push up. I do want to see how this volume fares for the rest of the day. But if it stays like this, low volume, where we had a lot of volume on the up move and low volume on the down move, then I want to see if I can get in on a continuation here off of the 50-day moving average on Datadog. But I wouldn't want to hold it until earnings. It would just be a 2-week play, to be honest. ASML up 5%, gave back a little bit of gains, but this to me is a monster stock for the long term. Already in that. One thing that's interesting is Nike is up 8% quietly in 2 weeks. Having a nice 3% day. My buy point on Nike is around 74. So hasn't really moved since I bought it, to be honest. Like it went up and went down, and now it's basing around, it started basing in the low 70s, and now we are seeing an up move. But for the first time in a long time, it was oversold on the RSI weekly. And you see that we have bullish divergence between the price and the RSI. So I think Nike does have a lot to prove. It is still a monster company in terms of revenues and cash. It's just hasn't been growing. That is the problem with Nike. There is zero growth there. Apple resilient today, just holding flat after a monster bounce off the 220. And Meta here flat, obviously waiting for earnings, but Meta it really depends on what they announce with regards to their AI spending. But I think the next wave of extreme bullishness is going to come from AI software names, right? Google, Amazon, Meta, potentially Microsoft. And I don't think we're going to see fast movement as much as we did in 2023 and 2024 on the AI infrastructure. So the chip names, the servers, et cetera, I don't think we're going to see fast movement in 2025.
The calculus on China and Nvidia and what it's meant and where those export controls already were an impact. I think the bigger issue is I wouldn't say it's existential, but what we had with DeepSeek over the last few days is one where are your biggest customers, has everybody overspent for capex, et cetera. That's the story with Nvidia. It's less to me about export controls in China. I'm sure the company's going to say and do and feel that they want to do everything that's on the right side of that. I'm less worried about that.
All right, let's move along to Tesla then, because this is always a hard one around earnings because they seem to move on not really earnings-related stories. But they will have their delivery forecast, any new projects or services, how Musk's government role could impact his work at the company if it's diminishing that somewhat. What do you do with the stock here?
It's always a fascinating earnings release. It's always a fascinating call. Again, Elon on this call, first time post-election, post-Doge, post-everything. There's a lot to listen into, including EV credits, and if he expresses a view on that, because that's another big story in terms of demand. I think the units delivery has been it makes this a bit of a non-event. We've gotten some of those numbers. I think it's about gross margin. And again, that's a function of everything from EV credits to demand to pricing and the competitive landscape. And a world where China is a big deal and where they care a lot about that. And it hasn't been a great time in China. So for a stock that even after a 20% pullback to where we're trading today from the recent highs, it's up 180% since last spring. I mean, we know what's going on with the stock. It's not cheap. I think today's earnings release is more about the insight into key issues for the company and that gross margin.
Yep. And again, like any kind of insight as to, how his role it might affect the China sales, so much more. We'll see if we get some good color on that. Which brings us to Caterpillar, which is always worth watching. I don't know if it would move, the whole market, but for everyone trying to figure out earnings trends for the whole year, things like that, Tim, just the health of the global economy, tariffs.
All right, we'll go back to CNBC when they, in 8 minutes, when they release the FOMC statement, and then 2:30 we'll have Powell. But the expected move on Tesla from here, 390 minus 30 is 360, 355. So the expected move is 355 or 425. That's the expected move on Tesla, right? So that right there, that right there is the expected move, right? So essentially when you get a strangle, you're expecting price to either go above or below the expected move. You don't want it to stay in between. If you buy a strangle and it stays in between, guys, hit that thumbs up. There's like 4,000 of you here. Hit that thumbs up, guys. If you buy a strangle and it doesn't surpass this, so if it stays under 425 or above 355, then you lose money on that strangle. So the strangle needs to be above this or below this. The price, of Tesla needs to be above this or below this, right? And if we look historically at Tesla earnings, AMD is not a buy, no. If you look historically at Tesla earnings, you can see that the options market overestimated Tesla's earnings only 17% of the time, meaning 83% of the time it beats the expected move, right? So the last 8 times in a row, it beat the expected move. So knowing that is why I want to buy a strangle here. So I'm going to be sending that out in the swings channel by end of day. By end of day, I'm going to be putting it in the swings channel. So if you're in the Discord, make sure that you look in the swings channel. No, AMD is not a buy. Not for me. If it is for you, that's great. We don't all have to agree. To me, AMD is not a buy. What do you think of Hood? Thoughts? I don't understand calls and puts. Then take the weekend and start Googling if you want to make money. All this information is free. VIX calls for FOMC. This is why most of you should be barred from having a trading account. If you wanted to trade VIX for FOMC, you would do it before, not after. I mean, not during. Buy Z's options course. You can, yes, the options course is, in my opinion, the most complete options course ever. But again, this information is also available for free. So just saying I don't know how to do this is not an excuse. You can spend your weekends learning how to trade options. The options course will get you there faster, but honestly, all the information you'll ever want is available for free. Are you favoring call or put side for your strangle? See, that's why most people should not have a trading account, because they don't want to take the time to learn. A strangle is a call and a put. So by process of elimination, I cannot answer your question because you're trading a call and a put. You want to know the reason why things such as online gambling, etc., why it's like so hard to regulate the stuff and make the stuff legal, but opening a trading account is so easy? It's because you are the liquidity. You think the markets are going to make it illegal for you to trade when you have done zero research or are not ready to trade? No, they're not going to stop you from trading. They want you to trade. How do you think they make their money? So it behooves you to really try and learn this stuff and not just throw money around. I think I will buy calls. I think I will buy puts. I think I will buy AMD. I think I will buy Nvidia. Yeah, that's what they want, guys. Anonymous, whoever that was, appreciate your donation so much to St. Jude's. Thank you. Waiting on the Fed minutes here, or the Fed announcement here, coming up in 2 minutes, and we'll see an initial reaction. Now, I can't be in a position because what you're going to see is this. So it will likely... This girl needs a new green screen and a new light. This is like what green screens looked like in 2003. It will likely take out both of your stops. So I would rather see where the initial move is going to be, and then I want to see where the manipulation is going to be, and then see if I can counter that trade. So, yeah.
A lower unemployment rate and some upward pressure on wage inflation.
Yeah, so David thinks we could be on hold indefinitely. Stephanie, you've gone to 1 cut from 2. Jim, you think, well, what do you think?
So I think it's somewhere between 0 and 1 cut this year. Look, for me, it's always about the labor market, and I'm surprised at how strong the labor.
This dude is saying that he thinks the Fed is going to cut between 0 and 1 times. That's crazy. Yeah. With Trump in the White House, there is no chance in hell they're cutting 0 to 1 time.
Is how serious...
Tommy, thank you for your donation to St. Jude. 1 minute until the Fed decision.
With somewhere around 2.5%, and is that good enough?
Right. And as we all know, that makes a big difference, a little bit over time and also in terms of what they decide to do on it. So we've got the pre-market set up, and a dovish hold maybe might be the consensus, maybe a cut or two. And we just heard Jim's between 0 and 1 cuts for the year, Brian.
Yep. And right now, let's get to Steve Leishman and the Fed's decision and call on rates. Steve.
The Federal Reserve maintaining the funds rate in the range of 4.25% to 4.5%. They did say that inflation remains elevated as it had last time, but they crossed out a line this time saying that inflation has made progress towards the 2% objective. Not 100% sure what that means. Perhaps we'll ask Powell about that. Is that hawkish or just getting rid of a tired old phrase? They say labor market conditions remain solid. They had said that they had eased, so they did an upgrade of the condition of the labor market, also noting that the unemployment rate has stabilized at a low level. The economy, as they said last time, is expanding at a solid pace. The committee is watching risk on both sides of its dual mandate. The committee is, the statement says the committee is still considering the extent and timing of additional adjustments. No hint as to when that might happen or by how much, and no change to the balance sheet reduction plan. They'll keep reducing the balance sheet as they have been. As the statement has said in the past, it says they're prepared to adjust policy as appropriate if risks emerge. And we have a unanimous decision with new voters for the new year. January 2025 is when they turn over. We have Schmidt from Kansas City, Collins from Boston, most of them from Kansas City and Goolsby from Chicago. So a bit of a Midwest contingent voting this time, sans Minneapolis. So back to you guys. Very much a staged statement, not much going on. And I don't know, Brian, can I use the phrase I reserve the balance of my time and send it over to you?
Well, wait a minute, Steve. You can't just drop it like it's hot, because I'm just going to tell you, Steve, what you just said. I'm going to quote Steve Leisman and Steve Leisman. Labor markets are solid. Inflation may get better. Considering additional timing of moves. This sounds like a Steve Leisman quoting a Fed ahead of a rate hike, not a rate cut.
You know, I guess so. I mean, I don't think that they're there at that point yet, Brian. I think the idea that the labor market remains solid is a positive that Powell and the Fed have that allow them to figure out which way they want to go with rates. But I still think there's an inference in the statement when they say, in considering the extent and timing of additional adjustments. And by the way, Brian, you do add the important point here, which is that one of the keys that I've been saying to this meeting is, does Powell affirm that with all the other things that are going on that y'all were talking about in the last segment, tariffs and tax policy and all the other stuff, will he affirm that the direction of travel is still downward? That's really important. Is he still confident that inflation is moving towards the 2% target? Those are the two monetary policy keys as I see them to the press conference that's coming up.
Quickly, Steve, usually the big mover when we get the statement is also the projections, the dots as I won't call them. But we did not get those this meeting, right? Which makes this a little bit, less for the market to kind of sink its teeth into.
Right, no dots. The dots come four times a year. I have no problem saying dots if they want to fire me for saying dots. By the way, this is a little inside baseball where we had an old boss who didn't like us to say the word dots. I don't actually know what the new policy is, but in any event, they come four times a year. There is one question, Kelly, we might ask the chair, which is he did answer it one time, and we said, hey, if you were to do the dots now, are the old dots still good? That might be an interesting question, though. I don't know that enough has changed now to ask him that question in terms of, you would say, well, I think the two cuts are still something that the Fed would more or less back. Remember, it was a close call last time.
Yeah, no, actually, that would be a good question. Would anything maybe change those projections? Steve, thanks. Let's turn back to the panel for more thoughts here, and maybe we'll go in reverse order. So, Jim, the 10-year, it's up like a couple of basis points, not a huge mover so far. What jumps out to you?
So look, I mean, effectively, there's a long period of time between the next meetings. So the next Fed meeting is March 19th. We get a couple of labor reports. We get a couple of inflation data points. We have a new president, new policies that are coming through. I think the Fed is right to be paused and be as really obscure as they possibly can at this point. So what's really jumping out to me effectively is how the Fed is thinking about the labor market. I think the inflation component is pretty well entrenched. It seems like it's relatively low and stable, and that's what I expect. But it's really the labor market. It's all of the adjustments that we get. We get these QCEW adjustments that always adjust things down, so the labor market may not be as strong as the headline numbers suggest. And I think that's really the worry point for the Fed, is that they're just not 100% certain on how strong the labor market actually is or is not, and that's going to make them react to hiking, or not hiking, but cutting more so than anything else. I don't think a hike is in the equation for this year.
Fair enough, Jim. And Dave, I was kind of making a point because the commentary, David, has been so positive. It's kind of weird that we're talking about rate cuts, and the Fed has already cut rates, when a lot of the rhetoric around it is actually fairly good. That said, and I don't want to drag politics kicking and screaming into this. We try to avoid that. There's plenty of other channels that do it. But I think Steve's point was well taken, David, which is that if we don't know what the policies are ultimately going to be around inflation and jobs and immigration, whatever, isn't it much harder for the Fed to do their job, because they kind of got to wait and see what some of these policies are?
Well, that's right. And if you sort of go back 6 months ago, I mean, 6 months ago, you could have said the unemployment rate's going up, but maybe it's not a problem. Inflation's coming down, but and maybe it's going to head towards 2%. Now we sort of settled into really very close to an equilibrium, but it's a hot equilibrium. We've got inflation a little bit above 2%. We've got an unemployment rate pretty low here. And then all the risk in terms of, what do we do in tariffs? What do we do in immigration? What do we do in fiscal stimulus? All of it has a potential for lifting inflation. So from the Fed's perspective, they really don't want to cut here. And I think the message is please don't expect a cut anytime soon from us here, because the last thing they want to do is have to hike rates or try to hike rates later on in the year if they feel like they've overdone it. So I think they'd really like to wait a while here before making their next move.
All right. So as we heard, the Fed just held the rates. That was as expected, right? And they said that the unemployment rate has stabilized, and they removed the line from last time about inflation being a threat. So a little bit of, I guess, good news, but we haven't heard Powell talk yet. What I'm waiting for here is I want to see the initial move was down, right? So we have this consolidation manipulation. I think that there will be an up move here before the Fed talks. But I want to see if the S&P 500 takes out this low here. I want to see there being SMT here before entering. So I want to see some kind of divergence here. Right now we don't have any divergence here, but I think that there will be an up move leading up to the Fed. If we take a look at the 10-year real quick, you can see that right now the 10-year is making a little bit of a stand here, up 0.62% for the day. And the dollar is also up slightly. I wonder if there's a short on gold here. Even though we just took London low, that's London low. We just took London low on gold. On the lower time frame, it looks like a long. I don't understand how you didn't understand favoring put, call, and strangle. Call closer to the current price is bullish. Put closer to the current price is bearish, but all right. Sure, but I'm talking about a 25 delta strangle on both ends. So the deltas are the same regardless. I'm not trying to guess direction. That's the whole point of playing a strangle. If you are favoring a direction, then why would you trade a strangle to begin with? You should trade something a little more asymmetrical. You can trade slightly biased? Yes, I know. Then why would you trade a strangle? My point is, if you have a bias, you are shorting yourself if you trade a strangle. The point of trading a strangle for Tesla earnings is because I have no idea where it's going to go. That's the point of the strangle. So you are just wanting it to make a big move regardless. Okay, so we took out this this low here on ES. This is the type of divergence I was looking at. So the low is 6046.25, 6046.25. I want to hear Rick Santelli real quick.
In my opinion, it's where we have been holding. We've been holding 4.5%. We've been holding 4 3/4 in a 30-year. And there's a lot more going on under the hood. Let's look at an intraday of twos. Okay, you can see what it's doing. Rates are moving up. But when you hook it into yesterday, what this did was this put today's yields above yesterday's high yield. There's twos. Now look at 10s. Same dynamic. Look at a 1 day, look at a 2 day. Look at 30s. Look at a 1 day, look at a 2 day. This is significant. The dollar index, as you see, had already traded above its previous day's highs. You know, what we are going through right now is, and I'm not sure what I like better when I reference it. Are we in uncertainty pricing or are we in disruptive pricing? Take your choice. And in either case, CNBC loves disruption. We have disruptor conferences. But it seems as though this administration, disrupting is a negative thing. It's viewed as negative. And when you look at the notion that everybody seems to bring forth is that all you need to do is change our target from 2% to 2.5% or 2 3/4 or 3%. It doesn't make a difference. I couldn't agree with any statements more than that. With the debt and deficit issues we have, with the disruptive pricing that we have, should they move the goalposts, you know what's going to happen, in my opinion? The market will penalize them via much higher interest rates. It's a bad idea. Yeah. And we could talk about it and talk about it, but in the end, if they actually do it or a senior Fed official actually voices it, my word would be buckle up.
Well, the market's already moving, and yields are indeed moving up. They are moving higher. I think it was Alan Greenspan, Rick, that said, if you understand what I said, I must have misspoke. Rick, thank you very much. All right, Bob Pisani, I hope our Fed panel is gone because I'm going to say something really just inappropriate here. Just if you're listening on the radio, turn the volume down. You don't want to hear this. Which is that, Bob, I feel like Nvidia right now, like the Fed, we know they're kind of on hold. Nvidia's not on hold. Nvidia's down, what, 5-6%? There's a lot of fears around stuff. So we're not only watching the Fed, and I think the press conference is very important coming up, but there's a lot of other stuff happening under the hood that has nothing to do with the Fed that I think is equally, if not more so important right now.
Including the big rotation we're seeing today. I mean, before this, there was more stocks up than down, and I agree there's obviously some money coming out of Nvidia. I just want to point out that up until a minute or so ago, the reaction to the stock end of this was very, very modest, because I agree with Steve's point. The fact that they left out this sentence, inflation has made progress toward the committee's 2% objective, does strike me as somewhat on the hawkish side. And remember, what you want here, and I think David said this earlier, you want the meeting to be boring, and boring would be Powell insisting that they are moving towards the 2% objective. And any suggestion that there's not going to be any rate cuts, 1 or 2, or that there might even be a rate hike, that's certainly not in the market. So there's your big risk right now. The other risk, of course, is Powell could get dragged into some long discussion about tariffs and what I call the swamp of tariffs with Powell, and that might introduce, of course, the probability or the possibility of some kind of accidental volatility, as I like to call it. So there's your two risks right now. Other than that, the handoff for February from the stock perspective is terrific. We have 3% GDP growth. We've got, 20% of the earnings coming in? They're all better than expected. Very high levels of beats that are out there. We are seeing a terrific rotation in January.
I'm looking for a potential long before Powell starts talking. But we do have these equal lows on ES. You can see NQ here with the higher low. I wish we had lower lows on ES as opposed to equal lows. but I'm looking for a long soon. I just need ES to potentially take out these equal lows here. We have Powell coming up in 13 minutes, guys. Okay, this is what I want to see here. Hopefully NQ doesn't take that low because ES is probably, yeah. So ES attacked those equal lows there. So I'm looking for a long. As long as NQ doesn't take that low, I might look for a long here. Boris, thank you for your donation, man. $50 to St. Jude's. Appreciate it. Hmm.
moving average. As you can see, we're just right now below it, so it represents one of those key chart levels some traders are watching. All of that, as you point out, on this Bloomberg report, citing people familiar that the administration has discussed potential tightening of sales curbs for Nvidia products to China. It did, though, say the report that the conversations are very preliminary, but it was enough to exacerbate an already down day. The general story in the chips trades does still remain mixed today. As you can see there, Broadcom, Taiwan Semi are down, while you see some gains in Intel and AMD. ASML Holding, though, continuing solid gains following a better-than-expected quarterly report and better-than-expected reads on future orders. And let's count things off with a check on the 3 of the Magnificent 7 that are actually reporting earnings today. Microsoft, Meta Platforms, Tesla, each you can see there just about lower to marginally lower. Each of them reports after the bell. The options, by the way, market is currently pricing in what could be a 4% up or down move in Microsoft on the heels of that report, a 7% move in shares of Meta Platforms, and a 9% move in shares of Tesla. So we could be seeing some possible fireworks, Brian Kelly, for some of these reports. Tesla's going to be a notable one to watch after the bell. I'll send things over to you.
Yeah, and interest rates, as you said, Dom, also move these high valuation and high multiple stocks. So if the Fed moves interest rates may move those stocks, which then are big enough to move the whole market. I don't know about my brain is exploding just thinking about it. Dom Chus, thank you very much. As we noted, folks, Dom's brain never explodes. It's so big. All right, we are just moments away from Jerome Powell's press conference. There's an empty lectern. That lectern is not saying anything. But when a human being walks into it, he's going to say a lot. Watch out. Watch out. We're back right after this.
All right, before Jerome Powell talks, I just want to say, guys, if you want to learn how to trade, I'm doing a free mastermind in terms of day trading and swing trading. February 2nd, 9 a.m. PST, noon EST. You have to be on this list to get in. Only the first 1,000 people that sign up will get in. It is almost capped. Make sure you click that link and sign up. It is absolutely free. All right, I might be considering taking a long here. NQ closed above this gap. ES didn't, though. So I need ES to get above that. Jerome Powell talks in 6 minutes. If ES doesn't get above this, there's no long yet.
Welcome back. Just a couple minutes away from Fed Chair Powell's press conference to explain what turns out to be kind of a hawkish statement top of the hour. They didn't cut rates, but let's talk to Claudia Sahm about what they did do. She's New Century Advisors chief economist, creator of the Sahm Rule, a member of our mock Fed panel. Hope you're feeling well, Claudia. It's great to have you here today, especially. Are people reading too much into the statement, do you think?
Yeah, we got to be real careful today not to make news out of what is not news. Right? Like coming into this, we knew what's left, inflation. Like that's what's left. That we got good news on the labor market, things have gotten better, and all the Fed is doing is telling us that's where we're headed. So I don't think the statement, the very small changes made to the statement should come as a surprise or tell us something we didn't already know. Like inflation is still somewhat elevated.
So you're talking to a trading desk right now, and it's like we're pounding stocks lower, we're sending rates higher. This is going to craft the narrative for the next 6 weeks. What do you want them to be thinking about?
Again, I think it's important in the press conference to take a deep breath. Right. The Fed, the actions of the Fed, and this has been true for some time, and it will absolutely be true for this year. It is driven by the data. We do not have the data that will decide when the next Fed cut is. We just don't. And Powell doesn't have it, and he's not going to give it. So trying to infer that from what he says is just noise. So we just really need to be careful about, we want to hear that information.
NQ short in the morning, yes. Right now, no. I think it's still yet to be seen. Because it did complete a nice sell cycle here. Nvidia just hovering here on the 200-day. It could actually spend weeks here. I showed this before, but if you look at back in 2020, 2021, it can hover around the 200-day for a while, but that is definitely an important level. All right, we got Powell coming up right now.
And play it cool, but he does need to. The Fed, when Powell speaks, he speaks for the Federal Open Market Committee. So, he needs to convey the concerns that come from the committee. And, again, at this point, with where the data is, where where the economy is, being concerned about inflation first and foremost, like that, that's inappropriate. And that's what I imagine we'll hear from him.
What you just said is so, well, there, you know what? We'll save it for the next segment. It's going to be really important. Here's Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in
Quick 500 on NQ.
The year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact. Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed.
Just scalping this, guys. Just scalping longs here.
We've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we literally look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points.
I don't see any broad trades here just yet, just scalps. I'm just scalping long here.
Real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I would say you look at the last couple of inflation readings and you see we don't overreact to 2 good readings or 2 bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret too good or too bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder. And meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin. But we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed, in general, wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, Throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, you know, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And you have to. It's hard to be open to just how broad the possibilities are for an economy. You know, no one saw the pandemic coming, and it was, you know, it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. You know, last month you talked about a future rate cut as being pretty, you know, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. You know, we want to see, you know, further progress on inflation, and you know, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, you know, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and, you know, housing services, the way it's calculated for PCE. You see that coming down pretty steadily now. And that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seemed to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment, participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all.
Wow, man, this is such boring speak. Yeah, just been scalping these moves here. Someone asked me how much I'm up. I'm only trading 2, 3. I'm only trading 8 of my accounts here, so I'm up about 600 and change on each, which is about $4,800. But just scalping this, I don't see a broad trade. And then in my options, I'm up 550 on the day, mostly from Costco. I do have a Russell 2000 buys here, but mostly from Costco. So pretty good day. Nothing too crazy in terms of moves just yet. The market does close in an hour, and I'm hoping to see a counter reaction to this move here. Now, on the 15-minute, like I said earlier, on the 4-hour, this looks bullish, right? This looks like we hit a 4-hour fair value gap, and for the coming days, it looks like we could at least come up to fill this gap. 15-minute looks pretty bullish, but on the lower time frame, this actually looks like manipulation to me. You have the consolidation. This is the manipulation. And there's a potential we see a move down after this fool stops talking. But yeah, I am potentially, oh man, Costco with the monster candle here. Let's go. Oh, this is heating up. This to me was one of the best looking charts in the market. I think Costco visits $1,000 pretty easily, pretty soon. I sent this out yesterday. I don't mind showing it now because it's already playing out. It's up quite a bit, but I sent out another round of Costco calls yesterday. I have longer dated ones and shorter dated ones, but yeah, and I might re-enter Datadog again here on this pullback. This breakout and retest at this level here, I really like it. So far on the day trading end, just a few scalps here and there, but pretty green overall. If you want to trade with me live every day, click the link in the description. I go live at market open every morning, but right now, all I see are scalps and a potential for this move to end down for the day. D-Dog on downgrade. Imagine basing your trading decisions off upgrades and downgrades. This is the reason those exist, is for you to enter and exit positions prematurely. Upgrades and downgrades literally mean nothing. They not only nothing, they are less than nothing. Meta call, I don't gamble for earnings, man. I think they'll do good on earnings, but I don't gamble on earnings.
You know, we're somewhat above that, as you know, and you know we want to see, you know, serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Oh, that's a good question.
You can't know with any precision, of course, as I like to say, that you know the neutral rate by its works. So I think, you know, at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You know, you can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But you know, not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria. Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, you know, the kind of footprint of trade has changed a lot as trade is now spread around. You know, it's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences. And I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know. And the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then
that's a very good question, finally.
I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
Another good question.
Let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So. We control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
You know, I want to avoid commenting even indirectly on the conduct of tariffs. You know, it's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, you know, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things. Asset prices are, and yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI, but we look at that. But you know, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions.
That's the first time you talked about the stock market, which is wild.
One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see, there's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But I know you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Have any of you guys traded anything significant? Oh man, Costco's heating up, guys. Costco's heating up right now. Wow, up 600 on these calls. Costco is heating up right now, man. Boner candle incoming. Uber still at a standstill. I still like it off this level. But Costco's heating up. Just been scalping, but I'm paper trading, getting chopped up in my demo accounts. We waiting on you? Bro, I'm just sitting here scalping. You're not going to be able to follow me if you don't know how to scalp. Some people know what I'm looking at and are able to enter and exit, but it's going to be very hard. Especially because the YouTube stream, I assume, is delayed by a few seconds. Just based on latency. But there is no broad, there's no broad trade here. Too difficult? Yeah, I can appreciate that. It is difficult. If Nvidia gets past this, past that 123 level, then I think it's money in the short term. Nvidia still looks like shit. I mean, sorry, AMD still looks like shit. For sure. It has to break this trend line. I mean, come on. There's no two ways about it. Is it too late to buy calls on Costco? Well, it's already up. I did open an iron condor on Tesla this Monday. Oof. That is brutal. Yeah, with the fact that Tesla beats the earnings move most of the time, that is brutal. But I wish you luck. I really do. Yeah, this has just been chopping around here. No big moves here. I did manage to grab part of this long. But that's all I traded.
I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago,
no way you bought calls on the VIX and closed for 50% today. No way. The VIX is up 1% right now.
Inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, we said what we said was that at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened.
Well, I mean, there's better things to lie on than the VIX. There's no way that anyone opened a VIX position yesterday and closed it for 50% today. Like, anyone that knows how the VIX trades know that is a huge lie. Those VIX calls that I opened on Friday, and then, we saw that the VIX pumped, what, like 40%? It took a 40% pump in the VIX for those calls to be up 60%. This guy's saying he bought calls on the VIX yesterday, and today the VIX is up 1%, and he closed them for 50% gains. Yeah, bro. You could have chosen something else to lie about. You could have said that you bought puts on Nvidia or something.
The Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and sound. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities. And that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal, just because of excess risk aversion may be related to regulation and supervision. So,
and with respect to households and their inclusion in the asset class?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements.
All right. Dr. Jennifer Berry bought the 1 p.m. dip on an NQ 1400 in eval account. Yeah, that's what I was scalping long was that move right there. But I took it once we formed SMT between ES and NQ right here. But I opened it after forming that SMT and closing above this 1 minute fair value gap. But I didn't catch this whole move. So I've just been, okay, let's see, he's done.
One in which there was no change in interest rates.
Okay. Let's see if we can find a trade here. Fuck Powell. Yeah, this still to me looks like it's setting up for a bullish move, but we might not see that today. There's 40 minutes until the market closes, and I still got to open up this Tesla play. Curious why Strangle and not a straddle? Because a straddle is the most expensive play in the options world. And you're essentially getting the same return. So I guess I pose the question back to you. Why a straddle and not a strangle? What is Coco? The fuck is this guy talking about? So that's a 4-hour fair value gap. That's the 2-minute inversion or 3-minute inversion. Isn't a straddle more risky? It just costs more. Appreciate the live stream, but please no ads. How about you kiss my ass, bro? How about you fucking start a YouTube channel before you start dictating how someone else runs their business? Or how about you stop being a cheap ass and get the fucking paid version of YouTube if you don't want to see ads? Instead of trying to dictate to a grown man how to run his business because you're too cheap to fucking pay for a premium. You're telling a grown man not to monetize his channel just so your pussy ass can get something for free. How about that? Didn't your dad teach you not to talk to a grown man about grown man business? Because mine did. I don't tell grown men how to conduct business, especially if I want something from them. So this fool wants my analysis, wants my trades, and on top of that, is trying to tell me how to conduct business on my own channel. I've never heard something more disrespectful in my life. Holy hell, Costco going crazy, guys. Up 1,000 today just off Costco calls. This guy said, you are a Trump voter for sure. I love it how basic human decency someone is bringing up politics. Like, I need a fucking politician and not my dad to teach me how to respect other people's businesses. Jesus Christ. Yeah, this is going to break to 1,000, I think, in the coming days. Wilhelmina says he's doing it for free already. Yeah, exactly. Who did you vote for? I voted for your mother in a wet t-shirt contest, Joey. That's who I voted for. And only because I felt sorry for her, because she said that she was running out of money and couldn't feed you. So I voted for Joey D's mom in the local wet t-shirt contest. And by the way, she was the only contestant there. She was the only one in a wet t-shirt. So I had no choice, but I also did feel bad for her. This is the pump we're looking for. When does Costco report dividend? February 7th. Yeah, by the way, those of you who are asking me, is it too late for Costco calls? I put this in the last week of videos for those that aren't in the Discord. Obviously, if you're in the Discord, you know about this. I might take the short-term ones off. Up 1,200 now on these Costco calls. I might take the short-term ones off. I'm going to take one off here. Let's see if I can get filled. Actually, wait, do I want to take one off? Hang on real quick. Coming up into dividends. No, I think the NASDAQ and the S&P are in a good spot here for a potentially bullish move. Multi-day. Nvidia looking pretty decent. It's going to hover around that 200-day for a while. But I like this. If it can get over 123 and close on the lower time frame, I think we'll see depending on what happens with Microsoft and Meta earnings, obviously, but I think we'll see some recovery tomorrow. So February 21st, hold on. Can you check gold? Gold is doing nothing, man. This you don't want to trade this chop, trust me. Hold on, I need to update this swing real quick. Up 25% on the new calls, taking half off here. Hell yeah. All right, let me look at Tesla real quick. By the way, this app that I'm using is called Public. If you're in the US or US resident, not only are options trades commission free, but they pay you a rebate for each option trade. So you get money back from the order flow. See, if you look at the order flow rebates, you can see here that it starts to add up, right? And I've only been using them really for a month. So pretty nice kickback here. And they also pay you 1% annualized on your cash secured puts, which is also awesome if you're an option seller. So sign up below for a free account if you are in the US or US resident. Okay, let's see. February 7th, 25 Delta is 430. And then on the put side should be, I think around no, even below. Wow. 355. So this is the strangle that I'm thinking of opening for Tesla earnings, and it's not a gamble. It's just based on previous earnings trades, right? So I showed this to you guys before, but I base all my earnings trades off data. I don't base it off emotions or what do I think is going to happen. I just look at the earnings. Is there an asymmetrical opportunity? Does the stock mainly beat the expected move? If yes, I made a video about this, by the way. Just YouTube the traveling trader earnings and you'll see the tutorial. But if it beats the expected move most of the time, then I buy a strangle. If it misses the expected move most of the time, then I sell an iron condor. So you can see Tesla routinely beats the expected move, which is why this is what I'm considering. Your delta is equal, but you don't collect even premium from both sides. You don't collect premium at all. This is a debit. Um, 8-second delay. Yeah. Do you know what's the usual IV drop on Tesla options after they release earnings? Yes. And this is a very good question. You can find this in a number of areas. You can find it in Thinkorswim. You can find the data anywhere really, but the same platform that I use to look up previous earnings, you can see here. The blah, 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 the implied volatility. Okay, result. So the implied volatility crush averages 8% after they release earnings. Or sorry, that was the last time, was 8%. The average is 13%. Sorry. All right, guys. Just scalping here. Pretty good day on the scalps. Up 600 across 8 accounts. Didn't really, wasn't really feeling the setups for abroad. I caught part of this move up. I do think that this is setting up for a long in the coming days. I do like the way that this looks. Obviously, we have this 4-hour fair value gap on NQ. Would love to surpass this. Nvidia, I still don't think that we're in the safe zone here in the short term. We did close above that 123 level. But in terms of the broader market, if you look at Nvidia, just currently sitting at the 200-day. What the fuck? Currently sitting at the 200-day, as you can see right here. And we can spend, I don't think this is going to be a type of boom moment. The only thing is watch Meta and Microsoft earnings tonight. And if Meta and Microsoft say that they are increasing their budget for AI capex, meaning they're going to spend more on AI, then that's actually what Nvidia is waiting on. None of this garbage with China, DeepSeek, none of that. It has to do with demand for AI chips, right? So if they say that they're increasing or keeping their budget on AI capex, you can expect a sharp move. Otherwise, Nvidia can spend a while here. So, to me, this is still not a short-term tradable scenario for Nvidia. I think this is just a long-term positioning play here. And yeah, good job for those who took Costco. I've been beating the drum about that. Might enter Datadog calls before market close, and we'll be sending out the alert for the Tesla Strangle. But I appreciate you rocking with me. Thank you guys so much for the donations to St. Jude's. And yeah, I'll catch you guys on